At first, it feels small, just a number on a screen. 0.1 BTC, 1/10 of a coin, not a whole Bitcoin, not life-changing, not the kind of number that makes headlines. But something shifts the moment you own it. Quietly, subtly, you start checking the price more often. You notice headlines you used to scroll past. You begin to care about words like halving, ETF flows, and hash rate. It's strange. You don't own a house with it. You can't retire on it. It's not even a full coin. And yet, everything changes. Because 0.1 Bitcoin isn't just a fraction of digital money. It's a psychological line. And crossing it pulls you into a completely different financial universe. Right now, Bitcoin sits in a strange place in history. Governments regulate it. Wall Street packages it. Institutions custody it. Yet millions still dismiss it as speculative vapor. In 2013, 0.1 BTC was pocket change. In 2017, it was a risky bet. In 2021, it was a serious allocation. In the next cycle, no one knows. But here's the uncomfortable truth. Most people who will ever own Bitcoin will own less than 0.1. Let's break that down. There will only ever be 21 million Bitcoin. That number is hard-coded, not promised, not projected, enforced. Roughly 19.5 million have already been mined. A few million are likely lost forever, forgotten passwords, destroyed hard drives, discarded laptops. Now imagine global adoption continues even modestly. If just 100 million people decide they want exposure, which is less than 2% of the global population, the math becomes brutal. 21 million coins divided by 100 million people is 0.21 BTC each. But that assumes perfect distribution, which is fantasy. Large holders exist. Early adopters exist. Institutions exist. Governments now hold some. So realistically, the average person, if adoption expands meaningfully, will never reach 0.1. Owning 0.1 BTC quietly puts you ahead of a massive portion of the planet in terms of exposure to a finite asset. And that's when the psychology changes. Because scarcity changes behavior. The moment you hold 0.1 BTC, you stop thinking in dollars. You start thinking in SATs. 1 Bitcoin equals 100 million Satoshis. So 0.1 BTC equals 10 million SATs. 10 million units of something that cannot be printed. Suddenly, volatility feels different. When Bitcoin drops 20%, your net worth doesn't just shrink. Your slice of the fixed pie remains the same. This is the first shift. Bitcoin doesn't care how many dollars exist. The dollar supply expands constantly. Central banks adjust interest rates. Governments issue debt. Liquidity flows in cycles. Bitcoin supply moves on rails. Every 10 minutes, a block. Every 4 years, a halving. Predictable, mechanical, almost boring, until you realize how radical that is. With 0.1 BTC, you begin to notice monetary policy differently. Inflation headlines stop being abstract. They become personal. When a central bank expands a money supply, your cash savings quietly dilute. When governments run deficits, bonds absorb it, until they don't. But your 10 million SATs, they don't change. The purchasing power might swing wildly in the short term, but the unit count stays fixed. That subtle distinction changes how you interpret economic news. It also changes your time horizon. Before owning Bitcoin, most people think in months. Pay cycles, rent cycles, annual raises. After owning 0.1 BTC, you start thinking in halvings. The halving cuts the block reward in half roughly every 4 years. It's not hype, it's code. In 2009, miners received 50 BTC per block, then 25, then 12.5, then 6.25, now 3.125. The issuance rate keeps dropping, not because demand changes, not because a committee votes, because the algorithm says so. With 0.1 BTC, you're no longer just watching price charts. You're watching supply issuance decay in real time, and that creates tension. Because demand doesn't need to explode. It only needs to remain steady while new supply shrinks. This is where the narrative shifts from speculation to structure. Most assets inflate. Stocks issue shares. Governments issue debt. Fiat currencies expand. Real estate builds new units. Bitcoin does the opposite. It tightens, slowly, relentlessly. Owning zero point 0.1 BTC feels small today. But if Bitcoin were to reach the same market capitalization as gold, roughly $13 trillion, each Bitcoin would sit dramatically higher than most current price expectations. Zero point 0.1 would no longer feel tiny. And that possibility changes behavior. You hesitate before selling. You question short-term trades. You become allergic to leverage. Because you start to see Bitcoin not as a trade, but as a position. That's the second shift. It moves from opportunity to insurance. Insurance against what? Monetary expansion, capital controls, banking instability, political risk. Even if none of those explode dramatically, the mere existence of a non-sovereign asset with fixed supply introduces a hedge into your personal balance sheet. And zero point 0.1 BTC is enough to matter psychologically. It's enough that you care, but not so much that you're reckless. Here's where the irony appears. The more you understand Bitcoin, the less you want to move it. Early adopters trade it constantly. Now many long-term holders barely touch their coins. Because volatility, once terrifying, becomes background noise. You've seen 30% drops before. You've seen 70% crashes. And if you study the historical cycles, you notice a pattern. Explosive growth, euphoria, crash, disbelief, slow rebuild. Repeat. Owning zero point 0.1 BTC forces you to confront this volatility personally, not theoretically. You feel it in your portfolio. And that emotional friction is where most people fail. They buy during excitement. They sell during fear. They never hold long enough to experience a full cycle. But zero point 0.1 BTC is enough that you start asking a deeper question. What if I simply hold? No trading. No timing. Just time in the market. Now zoom out further. Bitcoin isn't just an asset. It's a network. Hash rate measures computational power securing the chain. The higher it goes, the harder it becomes to attack. Every time the hash rate hits a new high, it signals something subtle. Miners are investing capital into infrastructure, warehouses, chips, energy contracts. Billions of dollars in sunk costs to secure a protocol that most governments still don't control. Owning zero point 0.1 BTC makes you part of that network. Not as a miner, but as a beneficiary of its security. You now rely on cryptography, game theory, and distributed incentives to protect your wealth. That realization is strange. Your savings no longer depend entirely on a bank. They depend on mathematics and economic alignment. This is where the narrative gets uncomfortable, because self-custody exists. When you own zero point 0.1 BTC, you eventually encounter question. Do I trust an exchange? Or do I trust myself? Hardware wallets, seed phrases, multi-signature setups. Suddenly, you're responsible. No customer service hotline can reverse a mistaken transaction. No central authority can reset your password if you lose your seed phrase. That responsibility is empowering and terrifying. It forces you to grow up financially. You start thinking about backups, redundancy, inheritance planning. You realize Bitcoin doesn't care who you are. It only cares if you control the keys. This level of sovereignty changes how you view the rest of your finances. You start asking, who actually owns my assets? Are my stocks held in my name? What happens if my broker fails? What happens if capital controls tighten? Zero point 0.1 BTC opens the door to these questions, not because it guarantees disaster, but because it proves an alternative exists. Now let's contrast the hype. Social media often frames Bitcoin in extremes. Either it's going to zero, or it's going to $1 million. In reality, markets are slower, messier. Institutional adoption doesn't happen overnight. Regulation evolves gradually. ETFs channel demand through traditional rails. Banks integrate custody. This normalization changes volatility over time. As liquidity deepens, the wild swings may compress. Or they may not, but the narrative shifts from rebellion to integration. And this creates tension within the community. Is Bitcoin meant to replace the system, or coexist within it? Owning zero point 0.1 BTC forces you to pick a thesis. Is this digital gold? Is it global settlement infrastructure? Is it a speculative asset riding liquidity cycles? Your answer shapes your behavior. If it's digital gold, you hold long-term. If it's a macro liquidity trade, you time interest rate cycles. If it's technological infrastructure, you watch developer activity and scaling solutions. Most people float between these narratives, and that's where confusion breeds volatility. Now consider distribution. Data suggests a small percentage of wallets hold a large share of coins. Whales exist. Institutions accumulate. But over time, coins disperse through exchanges, ETFs, and retail flows. zero point 0.1 BTC may feel small today, but as more participants enter, fractional ownership becomes a norm. The world already trades fractions of companies through stocks. Bitcoin simply compresses it into a digital bearer asset. Here's the subtle psychological pivot. With zero point 0.1 BTC, you stop asking, how many dollars is this worth? You start asking, how many SATs do I own relative to everyone else? And that question reframes wealth. Because in a fixed supply system, relative position matters more than nominal value. If global liquidity expands while Bitcoin supply stays capped, your relative share of the Bitcoin network becomes increasingly scarce. And scarcity has gravity. It pulls capital. It attracts narratives. It creates envy. But it also attracts regulation. Governments tolerate Bitcoin while it's small. They monitor it as it grows. If adoption accelerates dramatically, policy responses will evolve. Tax frameworks, reporting requirements, custody rules, perhaps even strategic reserves. Owning 0.1 BTC places you inside that geopolitical shift. You are no longer an observer. You are a participant. And participation changes perception. You start noticing how countries with unstable currencies experience high adoption, how remittance corridors use Bitcoin rails, how energy-rich regions monetize excess power through mining. It becomes less abstract, more real. Now here's the uncomfortable math. Let's assume Bitcoin reaches $500,000 per coin in a future cycle. 0.1 BTC becomes $50,000. Not retirement money, but significant. Now assume $1 million per coin. 0.1 becomes $100,000. Suddenly, a fraction equals a house down payment in many regions. But here's the twist. If Bitcoin reaches those levels, it likely means something else happened. Either massive institutional allocation, severe currency debasement, or a structural shift in global finance. In other words, the dollar value rising may reflect instability elsewhere. That's a paradox. You might celebrate the price, but question the world that made it possible. And that's where owning 0.1 BTC truly changes everything. It introduces dual thinking. You root for price appreciation, but you hope the underlying reasons aren't catastrophic. You benefit from volatility, but prefer stability. You distrust centralized monetary expansion, but rely on the broader system daily. It's cognitive dissonance, and it's uncomfortable, yet it's honest. Bitcoin doesn't eliminate risk. It redistributes it. Instead of trusting institutions entirely, you trust code and network consensus. Instead of inflation risk, you accept volatility risk. Instead of custodial dependency, you accept self-sovereign responsibility. 0.1 BTC is enough exposure to feel all of that tension, but small enough to survive mistakes. And that might be its hidden power. It's a threshold. Below it, Bitcoin feels like an experiment. Above it, Bitcoin feels like a strategy. Not because the number itself is magical, but because crossing it changes how you think. You read monetary history. You study past bubbles. You compare gold's 5,000-year run to Bitcoin's 15-year existence. You weigh Lindy effects against technological risk. You ask whether code can outlast politics. You start thinking generationally. Will this still exist in 20 years? If it does, what does 0.1 represent then? And if it doesn't, what did it teach you about money, trust, and scarcity? That's a final shift. Owning 0.1 BTC isn't just about potential upside. It's about perspective. It exposes the mechanics of money. It forces you to confront risk honestly. It makes you aware of supply schedules, network security, and global liquidity in ways most people never consider. You can ignore it. You can dismiss it. You can call it speculative. But once you own it, even a fraction, you can't unsee what it reveals about the financial system. And maybe that's the real reason everything changes. Not because 0.1 BTC guarantees wealth, Not because it guarantees collapse, but because it forces a question most people avoid. If money can be programmed, if supply can be fixed, if trust can be distributed, then what exactly is the future of a system we've always assumed was permanent? And if that future shifts slowly, quietly, over the next decade, will zero point 0.1 Bitcoin feel small? Or will it feel like you saw something early and decided to step inside it before the door fully closed?